ARMS, a creative and aggressive financing solution or disaster waiting to happen. Let's get into it. Now, when I say ARMS, I'm not talking about these bad boys right here. I'm talking about an adjustable rate mortgage. And like everything in the world of financing, the ARM can come in many different guises. But for the purpose of today's conversation, we're going to talk about the one that I'm currently offering, which is known as the 5-1 ARM, but its true name is the 5-1-1-5 ARM. But don't worry, we're going to get into what all those numbers mean and explain it so that you can understand and make the best decision for you and your family going forward. Now, an adjustable rate mortgage is exactly what it sounds like. It is an interest rate that will at some point and under some terms adjust during the lifespan of the loan. And how it adjusts is based on market conditions, which means it can go up, but it can also go down. And yes, there are limitations on how much that interest rate can change within a specified period and how much it can change over the entire lifespan of the loan. So when is this a good idea? Well, part of it depends on the product that you're using. But again, for the context of this video, we're talking about the 5-year ARM. And that first number, the 5, means that the introductory interest rate will be locked for that many years. So right now, our VA ARM rates are in the low 5s, which means, let's just say you started at 5.25%. That would be your locked-in interest rate for the first 5 years. Now, when is that a good idea? If you believe you're going to PCS within 3 to 5 years and sell the home, if you think that you may sell and upgrade into a new home within that first 5 years, if you are confident that you're going to have the opportunity to refinance at some point in that first 5 years, or if you're expecting a significant financial change for the better within that 5 years, it can also be a great solution. Why? Well, because my permanent VA rates are more along 5.8, 5.9. So we're talking a 0.75% difference between the ARM rate and the permanent rate. That is significant, but as we just stated, it is not without its risks. Because what if you do get into it believing you're going to PCS in 3 to 5 years and you don't? What if you get into it believing you're going to sell within 3 to 5 years and you can't? What if you get into it believing you're going to refinance in 3 to 5 years and you can't? Or what if you get into it believing there's going to be a very nice change in your financial circumstances and that just doesn't work out? So the ARM is a solution and can be a very aggressive and profitable solution, but there's risks associated with it as well. And you've got to understand those going in. So we've covered what the 5 stands for. Now let's move over to the first 1. And what this means is that after that 5-year intro period, your rate will adjust on an annual every 1 year basis. And again, it's based on market conditions. So yeah, the first inclination is to say, oh crap, it's gonna get higher, but it could actually get lower as well. It could go either way, but it will change once every year after that first 5 years. Now let's move over to the second one. And what this means is that the rate cannot improve or deteriorate by more than 1% each year. So going back to our initial example of starting out at 5.25%, it could not get worse than 6.25% in that first year, and it could not get any better than 4.25%. So these first 2 ones do give you some hedge against disaster, right? Because you don't have to wake up at the first of every month wondering if your rate's going to change. It's just going to do it once in that year. And you don't have to worry about your rate deteriorating by 2 or 3% overnight. Now, again, that is not to say this ARM does not come with its risks, because it absolutely does. Who wants to go from 5.25 to 5.7 or 6% or 6.2? Nobody. So the risks are there, but the rewards, the potential rewards are also there, because you could go from 5.2 to 4.7 or something like that, okay? So we've covered the 5, which is the introductory lock. The first one, which means that your rate will change on an annual basis. The second one, which means that it cannot improve or deteriorate by more than 1% in any given year. So what is that second 5 all about? Well, what that means is that the rate cannot improve or deteriorate by more than 5% over the lifespan of the loan. Okay, example, we're at the 5.25%, right? Over that entire, let's say it's a 30-year term, over that entire 30 years, the rate could not get worse than 10.2%, could not get better than 0.25%. Okay, so again, this one's a little bit broader, I get that, but there is some protection there, really against disaster more than anything, right? Because if, good Lord, if interest rates are at 10%, I think we've all got bigger problems, right? So that's what it means. When someone says the 5-1 ARM, the 3-1 ARM, the 10-1 ARM, the 10-5, whatever it is, like, first off, there's more numbers that go into it, so you gotta look into that. There should be 4 altogether, but that's what they mean, okay? Introductory lock period, how often the rate will change, how much it can change within that period, and how much it can change over the lifespan of the loan. If you are being offered an ARM or think it could be a worthy solution for you, please reach out to me. Let's set up a phone consult. Let's go over what products are currently available, where the rates are at for your credit score on ARM and permanent. Talk a little bit about your next 3 to 5 years and make sure that the risk is equal to the reward. If you like this content, please subscribe to my channel and check out my other videos.